Hello everyone, this video is about stock market indices. A stock index or stock market index is an index that measures a stock market or a subset of stock market that helps investors compare current price levels with the past prices to calculate market performance. An index helps investor to understand the health of the stock market, enables them to study the market sentiment, and makes it easier to compare the performance of an individual stock. There are thousands of companies listed in every stock market, making it impossible for monitoring each company individually. It created the need for creation of stock market indices. These market indices they bring together a selected group of company stocks and regularly measure their performance. It helps the individual to compare the performance of different stocks and makes them easier to take investment decisions. There are two major indices in the Stock Exchange of India, Sensex and Nifty. Sensex comprises of weighted average of market capitalization of stocks of 30 well-established and financially sound companies across different key sectors in India. Nifty comprises of top 50 companies in 12 sectors of the Indian economy in one portfolio. It reflects the health of Indian economy from a broader perspective. Sensex is an indicator of Bombay Stock Exchange and Nifty is an indicator of National Stock Exchange of India. This BSE and NSE are considered as the prominent stock exchanges of India. Sensex is the indicator of this Bombay Stock Exchange and Nifty is the indicator of this National Stock Exchange. Sensex comprises of 30 companies which are listed under Bombay Stock Exchange and Nifty comprises of 50 companies which are listed under National Stock Exchange. These Sensex and Nifty reflects the health of Indian economy in a broader perspective. Types of stock market indices: benchmark index, S&P BSE Sensex collection of 30 best performing stocks and Nifty 50, a collection of 50 best performing stocks, are indicators of BSE and NSE respectively. They are considered benchmark indices because they are the most concise, use the best practices of regulate the companies they pick, and hence are the best points of reference for how the market are doing in general. Benchmark is also considered as a standard. This BSE index, that is Sensex, and NSE index Nifty, they are considered as benchmark indices or standard indices because BSE and NSE are the standard stock exchanges of India. They have better regulating practices. With the help of these better practices, they give brief performance of the specific 30 or 50 companies which are coming under Sensex and Nifty. Therefore, they are considered as a standard benchmarks, standard indices. Second one is sectoral indices. Both exchanges, NSE and BSE, also have some indicators that are a gauge of companies falling under one particular sector. Indices like NSE Pharma and S&P BSE Healthcare are indicators of their respective exchanges for the pharmaceutical sector. Here, industries can be divided into several categories on the basis of their sector, maybe pharmaceutical sector, automobile sector. Indices representing a particular sector can be considered as a sectoral index. Here, NSE and BSE have specific indices for specific sectors. Market cap based indices. There are few indices that purely select companies only on the basis of market capitalization. Market capitalization is the market value of any public traded company. Indices like NSE Small Cap 50 and Standard and Poor BSE Small Cap are indices that are collection of only those companies that have lower or smaller market capitalization in accordance with rules by SEBI, that is Securities and Exchange Board of India. Here, market capitalization means the market value. The companies can be segregated on the basis of market value, like small cap companies or mid cap companies. Here, indicators or indices representing a particular category of companies, that is called market cap based indices. They may be the small cap indices or mid cap indices. Other indices, there are some other indices like Standard and Poor BSE 100, Standard and Poor BSE 500, NSE 100. These are the slightly bigger indices and have much bigger number of stocks listed on them. These indices are representing a particular stock market, or we can say the number of companies listed in a particular stock exchange. That is all about the different types of stock market indices. Benchmark index or standard index includes Nifty and Sensex. Sectoral indices, dividing the industries into different sectors and representing a particular sector with the help of indices. Market cap based indices, based on the market value of the companies, dividing the companies into different categories and using indices to represent these companies. Other indices based on the number of companies listed under stock exchange, representing these companies with the help of indices. Need for the indices. Indices are an important part of the stock market. Here is why we need stock indices. First one, sorting. In a share market, there are thousands of listed companies, and their shares are classified into indices based on key characteristics like size of the company, sector of or industry they belong to, and so on. Here sorting sorting means arranging the companies in a systematic manner. Here these indices help to divide the companies into different categories. It may be based on the size of the companies, that is mid cap, small cap, or based on the sector, that is pharmaceutical sector, automobile sector, or the industry they belong to, and so on. This is facilitated by the indices. Next one, representation. Indices act as a representative of entire market or a certain segment of the market. Here BSE, Sensex and NSE Nifty are considered as a benchmark indices. They are considered to represent the overall market performance. Here these indices are mainly used for representing a particular set of companies which are categorized in a particular way. Here it represent the companies on the basis of their size, or on the basis of their sector, or on the basis of the number of companies which are listed in a particular stock market. Therefore, indices are used for representation purpose. Comparison. An index makes it easy for an investor to compare the performance. An index can be used as a benchmark to compare against. Here, the investors can compare the performance of a particular stock with a stock market index and decide whether the stock is performing well or not. Therefore, these indices are mainly used for comparison purpose. Reflection. Indices help to reflect investors' mood, not just for the overall market but sector wise and across the company size. Here this investor sentiments is very essential factor in a stock market. If the investor sentiment is positive, it may lead to increase in the demand for a particular stock in the stock market. It will further lead to increase in the prices of those stocks. Therefore, this stock market index, it reflects the mood of the investor or investor sentiment. Next one, passive investment. Mainly in many investors prefer to invest in a portfolio of securities that closely resembles an index. This is called passive investment. An index portfolio helps investors to cut down the cost of research and stock selection. They rely on the index for stock selection. As a result, portfolio returns will match that of the index. Here, the investors may prefer to invest in those securities which are performing similarly to that of the stock market index. It helps them to cut down the this research cost on research. They are also able to make good amount of return with the help of these investments. That is called passive investment. These are all about the need of indices, that is sorting, that is classifying the securities into different categories. Representation, these indices helps to represent the different securities. It may be mid cap, small cap, etc. Comparison, here an individual can compare the individual stock performance with the index performance, thereby decide whether to invest in the stock or not. Reflection, these indices it represent the mood of the investors. And passive investment, it helps the investor to invest in those companies which are performing similar to that of these stock market indices, thereby they can cut down the cost and increase their profit. This is all about stock market indices. Thank you.